All right, hello and welcome back to the Broken Business Models podcast. We're your hosts, Ryan and James. And before we get into today's podcast, just a quick disclaimer how we start each one of these podcasts, but nothing in this video or any of our other content should be taken as investing advice. Today we're going to be talking about a small biotech company that is maybe particularly risky. So you should always do your own work and consult a professional before making any investment decision. Either James or I could have positions in any of the stocks that we mentioned and change our positions at any time without notice. So, with that being said, the topic of today's video is a biotech company called Ginkgo Bioworks. And Ginkgo Bioworks was a SPAC that kind of IPO'd at the peak of the SPAC craze in late 2021. But since then, after a little bit of hype at the beginning, when the stock spiked, it's been on a downward trajectory and appears to be going slowly towards zero. So there's some interesting things behind the scenes about this company that we want to get into today. So I'll pass it over to you, James, to explain what the why it is so concerning.
Yeah, so as you said, it SPACed at the peak of the SPAC mania in 2021, and it's declined by 80%. But the valuation was so obscene when they did the SPAC. I think it was like $15 billion, and they've done a huge amount of stock-based compensation, so the share count has increased. So despite the massive decline in share price, it still has a $3.4 billion market cap. So this is still a reasonably sized company. It's very liquid. It's not a penny stock by any means. So what is Ginkgo Bioworks? Ginkgo Bioworks, it's a synthetic biology company where they will create, genetically modified yeast and fungus. So they will manipulate the DNA in the cells to try to create new organisms which could have useful properties in the pharmaceutical or other industries. Now, one thing that's important to understand about Ginkgo Bioworks is that they have no proprietary technology, at least in terms of hardware. They buy all their equipment from companies like Thermo Fisher or Pacific Biosciences or whatever. So these are commercially available equipment that they buy that anybody could buy. So they don't have proprietary hardware. They just buy all this hardware, and then they are essentially a contract research organization where customers, be they pharmaceutical companies or other biotech companies, can go to Ginkgo, pay Ginkgo to do this biotech research for them, and create these genetic modifications for them in return for cash and other payments. So it is at its core, it is a contract research organization. Now, they have two segments. The first is called cell engineering. That is the core business. That is, pharmaceutical company or whatever comes, pays them to do some research to develop a new type of cell. And then they also have the biosecurity segment. So biosecurity is really just COVID testing. So in 2020, with the rise of COVID, they started offering COVID tests. This was obviously a huge amount of revenue growth. Um, and then that has tanked over the past year or so as the COVID pandemic has been alleviated. Now they also do some other. Now that the COVID revenue is dried up or is in the process of drying up, their biosecurity segment has pivoted to doing testing for other diseases. But this is a low margin, commoditized business that is losing money, or it's almost certainly losing money. It's hard to tell because they don't give very good segment level disclosures. But this biosecurity testing business, it's not something to be excited about. Cannot it cannot justify Ginkgo's valuation. And really, what investors are excited about are the cell engineering piece, because the cell engineering, the synthetic biology, that's where they've made all these promises, saying like, "Oh, we're going to revolutionize the drug industry. We're going to revolutionize a bunch of stuff with our genetic modifications of cells." So for the rest of this presentation, we're just going to focus on the cell engineering segment. The biosecurity thing was really just an for the most part an opportunistic thing they did during COVID. That's now over, and it's a low margin commodity business that really even the bulls of Ginkgo are not that excited about. So one of the biggest concerns with Ginkgo Bioworks, going back to before they even did the SPAC, was that they, at least at the beginning, there were not very many customers who were actually willing to pay Ginkgo for their cell engineering services. So what Ginkgo did in response, when you don't have any customers, what do? Well, you can create customers. That's what Ginkgo did. As an example, in 2019, Ginkgo created a subsidiary called Motif Foodworks, which creates fake meat, and they use Ginkgo's cell engineering services to create cells, non meat, fake meat cells that they can use in their burgers. Um, so they created this Motif Foodworks company and they spun it off. And then they had a deal where Motif pays revenue to Ginkgo Bioworks, and Ginkgo can then recognize that revenue. Now, Motif Foodworks has they have developed a few fake meat burgers, but to date they are not available in any major retailers, and the revenue that Motif itself generates is likely minuscule. And we can show why it's minuscule shortly. Um, but because they spun it off, um, and they deconsolidated it. Motif pays Ginkgo, and then Ginkgo recognizes that revenue. So um, in 2022 in 2020 through 2022, they recognized more than $40 million from Motif Foodworks. Now, during this same period, Motif generated zero or negligible revenue, nothing close to $40 million. But because they deconsolidated it and then created Motif as a customer, um, they are able to recognize very large amounts of revenue. And they've done this many times. They have many of these spin-off companies, which Ginkgo creates it themselves. They spin it off, deconsolidate it, have these companies that they created become customers, pay Ginkgo revenue. Ginkgo recognizes the revenue to show that they have revenue, but there is no revenue from end customers because these spin-off companies themselves are generating almost no revenue. So that is really the reason, at least one of the motivations to spin these companies off is so that they can, Ginkgo can then recognize that revenue from the payments from the spin-off companies. Because if they did not spin them off, if Ginkgo just left them consolidated on their own balance sheet, then they would recognize almost zero revenue because these companies themselves have zero revenue from end customers. And from the very beginning, the CEO of Ginkgo Bioworks, Mr. Jason Kelly, has made what I believe to be extremely misleading statements to investors. So, this is an interview right after the IPO. He was talking about how great Ginkgo is as a platform. He said, the folks at Motif, that's Motif Foodworks, the spinoff company, they're food scientists. They're expert food people. They're making like impossible burgers. They didn't have any biotech people. Ginkgo handled all that. It's like outsourcing to the cloud if you were starting a website. So the picture he's trying to paint is that you have these startups like Motif Foodworks, don't know anything about synthetic biology, but they need to do some synthetic biology, so they will outsource that to Ginkgo, and they themselves have no expertise in it. Well, that is not true, not even close to being true, because Motif was created by Ginkgo itself, and it used to be owned by Ginkgo. So how can you say that Motif has no expertise in biology when they literally was created by Ginkgo Bioworks itself? So if you watch this interview, you can go find it on YouTube. You would get the impression that Motif Foodworks was a real unrelated customer, when in reality it was a related party customer that Ginkgo created for themselves. So this, in the reliance on related parties was very extreme in the case of Ginkgo. In 2020, which was the year before they did the SPAC, 72% of their cell engineering revenue came from related parties. So that's these spin-off companies like Motif Foodworks. And so when you have a huge percentage of revenue coming from related parties, that is always a cause for concern. And this drew criticism from short sellers. In particular, there's a short selling hedge fund called Scorpion Capital in October of 2021, shortly after the IPO or SPAC. They released a short report basically saying that the revenue is fake because it's basically these fake customers like Motif Foodworks are responsible for the majority of revenue. So this was, a huge bear case and a huge concern for Ginkgo. And Ginkgo, it appears they knew that they needed to solve this problem. If they continued to rely heavily on related parties, investors are going to be very concerned because it looks like their services are not good enough for an unrelated party to want to spend money on it. So over the next couple of years, they have been decreasing their related party revenue and increasing their revenue from unrelated parties. So this chart here shows related party revenue as a percentage of total revenue. It was 72% in 2020, but they signed on some more unrelated parties over the years, and that percentage of related party revenue has been steadily decreasing to just about 15% in the first half of 2023. So that is a big positive and gave assurances to a lot of investors. Now, the problem is part of the way that they've been able to decrease their dependence on related parties is obviously they have to find unrelated parties who are willing to pay for their services. Now, it appears that there's not that many unrelated customers who are willing to pay them cash. So what they do instead is they'll find these early stage startups, early stage biotech startups that don't have the cash to do this cell engineering on their own and don't have the cash to pay a different contract research organization to do it for them, because most contract research organizations only accept cash. And Ginkgo will instead say, okay, if you don't have the cash to pay us, you can pay us in stock instead. And so they call these non-cash considerations. So even as their related party percentage was decreasing, their percentage of revenue from non-cash considerations, so getting paid in stock instead, has increased massively. And in 2022, the majority of their cell engineering revenue was in the form of non-cash considerations. So they're getting all of these. They're getting all this stock and all their customers who are startups, and then so on their books they have a huge amount of equity in all of these startups. Now, it can be very difficult to value startups, and there can always be controversies with your valuation method. But if we look at the facts in 2021 and 2022, and even in the first half of 2023, they've had massive losses on their investments, right? So they had almost $100 million of losses on their investments in 2021 and 2022, and then $10 million of losses in the first half of 2023. So they're getting paid in equity, but then this equity ends up being worth a lot less than they marked it as, and they had to take massive impairments and suffer these massive losses. So it's a big concern when you're getting paid not in cash, you're getting paid in shares of speculative startups that you end up having to mark down. So that's a big concern. Another big concern is they did a very strange transaction near the end of 2022, and it looks like possibly they're resorting to accounting gimmicks to further decrease their reliance on related party revenues. So there's a large agricultural and fertilizer company called Bayer, I don't, and in October of 2022, they paid Bayer $80 million to buy one of Bayer's facilities. And then they agreed that Ginkgo will continue operating this facility, which does research for Bayer. And then in return, over the next 3 years, Bayer will pay Ginkgo $90 million. So they will. It appears that they will be recognizing $90 million over the next 3 years from Bayer. But they just paid $80 million to Bayer, and then they have to pay the operating costs of operating this facility, which is basically on behalf of Bayer, because Bayer is the only customer of this facility at the moment. So they're probably going to be spending more than $90 million over the next 3 years when you include the initial $80 million purchase price and the operating costs of the facility. So this looks like a round trip investing where Ginkgo pays a bunch of money to Bayer, and then they conduct this research at the facility on behalf of Bayer, and then Bayer turns around and pays them back that money, that $90 million. Now, these round trip situations are always concerning, because if Ginkgo was really so good that their services are worthy of their price, then why do they need to pay Bayer 80 million in the first place? Why wouldn't Bayer just pay them $90 million without this? So this looks like a round trip investing. And so here I had these are the results from the previous few years. The blue line is the reported cell engineering revenue from Ginkgo. This orange bar is the subtracting related parties. So this is only including unrelated parties. And you can see that in 2020, the unrelated party revenue was tiny because they were so reliant on their spin-off companies. And then, but over the past couple of years, the revenue has been increasing from unrelated parties. But a lot of that is non-cash, as we explained before. Now, in 2023, I took the revenue from the first half of 2023, and I multiplied it by 2 to get the 2023 run rate. But then I subtracted $30 million, because that's $30 million of revenue that they're going to recognize each year from the Bayer round trip transaction. So if you subtract that Bayer round trip transaction, their 2023 run rate of cell engineering revenue is actually on track to decline by 10%. And then revenue from unrelated parties is on track to decline 27% after taking out the Bayer revenue. And then cash revenue, so excluding the non-cash considerations, is on track to decline 42%. So it appears that this apparent round tripping transaction was necessary for them to continue showing revenue growth, because if you strip it out, the revenue is actually declining. And excluding the Bayer transaction, is despite the fact that they spent $300 million on acquisitions in 2022. And we'll get into that these acquisitions later. And the reason I got so concerned when I saw the apparent round tripping transaction with Bayer is because this is not the first time that Ginkgo has done or tried to do an apparent round tripping transaction. In 2019, they invested $80 million into a biotech company called Synlogic. Synlogic has since failed. The stock has declined by 99%, has a $13 million market cap, and is on the brink of bankruptcy. So whatever services they got from Ginkgo obviously have not worked out for them. But in return for this $80 million investment from 2019, they received stock and warrants in Synlogic that had a market value of $50 million based on market prices at the time. So they paid a $30 million premium to invest into Synlogic. As part of the same deal, Synlogic prepaid $30 million to buy Ginkgo's services over the next 5 years. So this looks like an obvious case of round trip investing. You invest money into Synlogic, and then over the next 5 years, Synlogic pays you back some of that money in exchange for your services. Now, Ginkgo's based on GAAP rules, this is not allowed to be. You're not allowed to recognize this as revenue. So it appears that when Ginkgo tried to do or when Ginkgo filed for their SPAC transaction, the auditors probably told them, hey, look, you guys can't recognize this revenue because it's a round trip. Now, the reason I think it was the intention to have this as a round trip to generate revenue is based on the fact that in their SPAC presentation, Ginkgo included a non-GAAP metric called billable revenue. Now, so Foundry is cell engineering. They used to call it Foundry. They later changed the name to cell engineering, but Foundry is cell engineering. So they created this new metric called billable revenue. And the billable, if you look at it in 2020, this is from their SPAC presentation, the billable revenue is about $5 million greater than the reported GAAP revenue. And they give a reconciliation. And it's because of this sin logic adjustment. So it appears the auditor didn't allow them to recognize this round tripping sin logic revenue as GAAP revenue. But they still wanted to show investors a rosy picture, so they included it in their made up metric, billable revenue. Now, if you look at this, there's a $4 million difference between billable revenue and GAAP revenue. But then in the projections, they're projecting that the revenue is going to increase a lot, but they're saying that the revenue and the billable revenue are going to be the same, exactly the same going forward. Well, this is mathematically impossible because the SynLogic deal goes through 2024. And so through 2024, the GAAP revenue will be lower than the billable revenue because they have to subtract these SynLogic round tripping that the auditor doesn't let them recognize. But if you look here in fine print, it says GAAP adjustments not projected. So they're giving you what is an unrealistic and in fact impossible projections of GAAP revenue, because it's saying that the billable revenue is going to be the same as the GAAP revenue, which cannot be true. So this is a very shady SPAC presentation where they're giving what are frankly they're utilizing non-GAAP measurements that they make up, which include this round tripping, to paint a rosier picture for investors than is the reality. And then they're erroneously saying that their GAAP revenue is going to be the same thing. So this is a huge red flag when they're playing these accounting games in the SPAC presentation. Another big thing with Ginkgo, they like to tout is their downstream revenue. So how it works is if you're a customer of Ginkgo, you want them to develop, to do some cell engineering for you. You pay them an upfront fee, and then you also have to sign a contract that in the future, if the cell engineering works out and they give you a useful cell, and then you commercialize that and you sell some product that includes that cell, you have to give Ginkgo a royalty for each product that you sell. Now, they say that's the big bull case for Ginkgo. They talk about it all the time, how, oh, this is so great, we're helping our customers develop revolutionary new things with our cell engineering, and then we're going to get that value on the back end with this downstream royalties. And they specifically said, I believe this was from their Q4 2022 investor presentation, over time we expect downstream value share to be the bulk of our revenue and be more recurring in nature. So this is really, they're saying this is going to be the majority of their revenue. So how has it actually turned out? So far, the vast majority of their downstream revenue has come from just one customer, the Kronos Group, which is a cannabis company in Canada. And they helped Kronos to develop a new type of cannabis cell, a genetically modified cannabis. And then Kronos made a gummy bear, like a CBD gummy bear out of it that they're selling. And they did receive some milestone payments from Kronos because this one individual, because this thing did in fact work out. And so they received about 25 million of milestone payments in 2021, and about say 34 million of milestone payments in 2022. So this is one example of where the downstream revenue worked out. But as we will see, in the vast majority of cases, it doesn't work out. So this is also from their SPAC presentation, and they talk about how they expect to receive downstream revenue. So there's when a customer wants to use Ginkgo, right? They have to pay an upfront payment to get to develop the new cell. And they say upfront payments cover the R&D costs. Ginkgo gets an upfront payment that covers the R&D expense, and the downstream revenue should be pure profit, right? Because the cost was already covered by the upfront payment. And they show in their SPAC presentation that they expect the royalty streams to begin appearing at year 4, and then it will only increase from there, right? So maybe it takes 4 years for the cell to be created and for the customer to commercialize the product, and then starting in year 4, they should start to get royalty payments, and then those royalty payments will only increase thereafter. So this is their projection from the SPAC presentation. So how has this actually turned out in reality? Well, first off, they claim that the um, upfront payments cover the R&D costs. This is not even close to being true. You can see their cell engineering revenue versus their R&D expense. It is, their R&D expense is orders of magnitude greater than their cell engineering revenue. So I don't know why they're telling us this when it is clearly not the case in the numbers. But more importantly, the downstream revenue. So as of 2019, according to their Form S4, they had 36 active programs. So they had 36 programs of cells that they're developing. And some of these projects go back as far as 2015. So they started one with this company called Robertet in 2015, some of them 2016, 2015. So they have been developing these cells for customers for a long time. And now it's 2023. We're 4 years away since 2019. So of these 36 active programs, they say within 4 years they'll start getting royalty revenue. So we should expect to see close to 36 streams of royalty revenue, right? As it turns out, in the first half of 2023, they generated immaterial royalty revenue. So in their presentation, they say they received $1 million of royalty revenue in the second quarter of 2023. In the first quarter of 2023, they also say they received $1 million. Now, because they only it's by the million, they don't set, they don't give you any decimal places. It could be negligible. It could be like 100,000 or maybe zero, or say some smaller amount of money, and they just round up to 1 million. But I mean, remember, this is a company with a $3 billion market cap and is spending hundreds of millions of dollars, or at least tens of millions of dollars a year on R&D. And $1 million or less than $1 million is basically immaterial. So in the first half of 2023, they generated an immaterial amount of downstream revenue. And they did receive these royalties from, or these milestones from Kronos, and then they received a very minuscule amount of royalties. This was from a different customer, and they said who the customer was. It was a pharmaceutical company called Aldevron. So based on their public statements, they say that they've, since the SPAC transaction in 2021, they have only received any downstream revenue from 2 customers, Kronos and Aldevron. And it's been a minuscule amount of money from Aldevron, a significant amount of money from Kronos. But then in the first half of 2023, they're generating basically almost zero revenue. So this shows kind of promises versus reality. They working with all these companies within 4 years. We're going to start receiving royalty payments. Well, it's been more than 4 years for most of them, and we're not seeing any revenue, minuscule revenue. So it seems that the vast majority of these projects do not work out, and the products cannot be commercialized, and then Ginkgo does not receive any revenue from the downstream. or insanely minimal amounts of revenue. However, they like to tout their backlog of milestone and royalty payments. Well, this one is specifically milestone payments. And they say that, okay, we are working on all of these projects, and we thus far to date they've only received significant milestones from one customer, Kronos, even though they're working with dozens of customers and have been for many years. But they say, don't worry, we have this massive backlog worth $2 billion of milestones that we expect to generate over the next coming years. So, we just give us a bit more time. The revenue hasn't come in yet. The milestone revenue hasn't come in yet, but just give us time and eventually it'll come. Now, of this $2 billion of milestones, they disclosed that more than half of it, so more than $1 billion of their milestone backlog is from one customer, Selecta Biosciences. Selecta Biosciences is a publicly traded biotech company that is a penny stock with a market cap of $150 million and looks to be on the brink of bankruptcy. Their revenue is collapsing and they're losing tons of money. So the idea that you're gonna say that you expect to get $1 billion of milestone payments for this company, which has a market cap of just $150 million and is the stock price is collapsing. This is absurd. So I think we can just say that their milestone payments, it's just their expectations of milestone payments is just BS. Another issue with Ginkgo is they give press releases that are extremely misleading, in my opinion. So in August of this year, obviously with all of the AI hype, every company wants to show that they're doing something related to AI, and that will hopefully get a lot of interest from investors. And so in August, they announced this press release. Ginkgo Bioworks and Google Cloud partnered to build next generation AI platform for biological engineering and biosecurity. Now, if you look on this day, August 29th, the stock initially surged like 20% on this news because it looked like some great, AI partnership with Google. And if you look at the press release, it says Ginkgo intends to make Google its primary cloud services provider. They then say the partnership to include funding from Google Cloud to enable Ginkgo's development of foundation models. They say Ginkgo intends. Yeah, see, this is basically the same thing, right? Google Cloud, they have a partnership with Google Cloud where they'll use Google's cloud services, and Google Cloud will provide funding to help Ginkgo achieve certain milestones over the next 3 years. This looks like a great thing. Google Cloud is so confident in Ginkgo's abilities that they are even willing to pay Ginkgo to come and join Google Cloud. Well, if you look at the Form 8K, which they released concurrently, it paints a very different picture. As it turns out, as part of the deal, they had to enter into a 5-year agreement with Google Cloud that includes minimum annual commitments to purchase cloud hosting services. So each year, they are required to spend a minimum amount of money, pay a minimum amount of money to Google Cloud. And if you add these all up, it adds up to $289 million that Ginkgo is required to pay to Google over the next 5 years. And then Google Cloud will provide up to $56 million in cash funding upon Ginkgo's achievements of certain milestones. So they had to pay this huge amount of money to Google. They will get a much smaller amount of money if they achieve milestones, and these milestones have not even been disclosed. So we don't know what they are, and we don't know how realistic it is that Ginkgo could even achieve them. And this paints an extremely different picture from the much rosier picture they talk about in the press release. If you read the press release, it says nothing about minimum spending guarantees to Google Cloud, and they say Google Cloud will provide funding to help Ginkgo achieve certain milestones. Well, that is not the case because these potential payments cannot help Ginkgo achieve the milestones because they are only paid after the milestones are met, which may or may not even happen. You can't say that it helps you to achieve, you can't say the payment helps you to achieve the milestone when you only get the payment after the milestone. So this is an example. This is a trick that a lot of companies play. They'll have some deal, and then they'll release a press release, which gives a very misleading picture. It only talks about the good things about the deal. But then in the Form 8K, which most investors don't read, you see the reality, and it's actually far less favorable. And as I said earlier, we would talk about some of Ginkgo's acquisitions, and this one, Zymergen, Zymergen is another synthetic biology company. It's very similar to Ginkgo Bioworks in the actual technology and what they do. The big difference with Zymergen is instead of creating all these spin-off companies and customers and trying to get revenue from customers who pay them to use the service, Zymergen instead develops products on their own and tries to commercialize it themselves. So it would be as if to see what Zymergen's strategy is, it would be like if Ginkgo, instead of spinning off Motif and having Motif pay it revenue, it would be as if um, Ginkgo just held kept Motif as a consolidated kept Motif consolidated on its own balance sheet and hoped to eventually generate revenue by selling the fake meat burgers, right? By selling the end product. So Zymergen was trying to develop the products themselves and then actually sell it to end customers. They IPO'd in 2021 at a $3 billion valuation. There was a lot of hype around this company because they made big promises about the great powers of synthetic biology. As it turns out, Zymergen completely failed as a business. The products it made were failures. They were not able to generate significant revenue. Here, see Zymergen stock plunges 68% after saying product revenue will be immaterial. So Zymergen completely failed as a business. And then, uh, as the stock price tanked, Ginkgo actually acquired them in July of 2022 for $300 million, which was roughly 1/10 of the IPO valuation, which was just a year prior. Now, the fact that Zymergen failed because they were not able to commercialize their product, but is Ginkgo really doing any better when they are generating immaterial revenue from their downstream revenue? And the downstream revenue is an indication of whether or not end customers are actually using any of these cells that they create. So from that perspective, from the perspective of end customers actually using any of these cells, Ginkgo has been just as much of a failure as Zymergen. But because Ginkgo has all these customers, because Ginkgo is a service company, they are still able to generate revenue, even though a large percentage of that revenue is from related parties and also from non-cash considerations, which they eventually have to mark down. And if you think about the valuation, it might look like, okay, the stock is down 8. Maybe that makes it a good value, right? A good buy because obviously it'd be better to buy the stock at $2 than buying it at $10 when the transaction closed. But it doesn't matter if the stock is already down 82%. If the company is ultimately worthless, it still has 100% downside. And you look at the massive losses that they're making, which are compared to their minuscule revenue. And you have to take a step back and see that Ginkgo Bioworks was founded in 2008. So 15 years later, in the first half of 2023, they have generated an immaterial amount of downstream revenue. So basically, the business has failed, just like Zymergen. It's just not as obvious as Zymergen because they still are receiving revenue. But at the end of the day, if they're not even able to create cells that are useful to end customers, the business will not be sustainable. And then perhaps the best sell indicator for Ginkgo Bioworks is the fact that Cathie Wood's ARK Invest is a major bull. And you see they've been buying the stock since the beginning, and they continue buying more and more stock as the price collapses. And currently they own 170 million shares, which makes them one of the largest shareholders of the company. I think they own about 10% of the company. So why is Cathie Wood so invested in this stock? And I think it's always, whenever you're looking at any stock, either from the short or long perspective, it's always a good idea to look at the other side. What are the arguments that the bulls are making and see whether or not they hold any water. So in October of 2021, ARK Invest released a blog post about Ginkgo Bioworks, and they talked about this was shortly after the Scorpion Capital short report. So a lot of this was trying to refute a lot of the bear cases from that short report. Um, and so, obviously, the biggest points of contention were their kind of shady related party deals with their platform ventures like Motif, as well as their structured partnerships, which is like SynLogic. And they say that this is the ARK Invest employee trying to justify all of these kind of arcane accounting structures Ginkgo was creating. He said that the reason Ginkgo had to create these platform ventures and then spin them off was because at the time the value proposition for customers was lower because Ginkgo had fewer proof statements. So he's saying when Ginkgo was first getting started, um, unrelated customers, did not trust them. So they had to prove that their platform is legitimate and their capabilities are legitimate, and they did that with their own platform ventures, which they created. Well, to be clear, Motif Foods was founded more than 10 years after Ginkgo Bioworks after Ginkgo Bioworks itself was founded. So even after 10 years, they still have not proven their value. So that's one thing to consider. And they say Ginkgo likely didn't want to dilute its intellectual capital by developing assets internally. So I'm not sure exactly what he's trying to say here. Maybe it's a distraction to develop the Motif fake meat internally, so they instead want to spin it off. But if you really think it's going to work out so well, why wouldn't you keep it on your own balance sheet, right? And then he said, spinning out platform ventures means Ginkgo avoids competing with potential customers. Now, this is kind of a BS rationale because even after spinning them off, Ginkgo still retains a significant equity ownership in these companies, in these spinoffs. So they still have an incentive for those spinoff companies to do well. So I don't see how that would alleviate any concerns from competitors. Just because you deconsolidated it does not mean that you no longer have an interest in it. So this point doesn't really make sense at all. Now, but what gets even more curious is when he tries to justify these structured partnerships. So he talks specifically about SynLogic, and he said it's actually fine because Ginkgo may choose. Oh, sorry. Ginkgo may choose to receive low-cost basis equity as a form of prepayment for R&D services. So he's saying is that Ginkgo can go to a company like SynLogic and say, um, if you wanna use our services, instead of paying us cash, you can instead give us equity. And he specifically says low cost basis equity. So it sounds like you could issue a stock at a discount. In return, we will give you our cell engineering services. The problem is it's just not true. In reality, Ginkgo paid a massive premium to SynLogic stock price, and then SynLogic paid the difference back to Ginkgo. So it was not low cost basis equity. It was high cost basis equity. It was basically just a round tripping transaction. So what he's saying here is just simply not true. And then he tries to justify it by saying everything is above board. Ginkgo has been transparent with us because you can see how Ginkgo adjusts for its non-cash equity compensation from SynLogic on slide 51 of Ginkgo's May Investor Day presentation. So let's look at that May Investor Day presentation that this ARK Invest employee says exonerates Ginkgo. But before we do that, one quick note is Ginkgo always has these pictures of dinosaurs in their marketing materials, which is completely ridiculous. They have nothing to do with dinosaurs. It's just a clownish thing they do to try to make themselves look cool. And this ARK Invest person has fell for it because he includes dinosaur pictures on his blog post as well. But this is the slide 51 that he's talking about. So in 2020, Ginkgo's GAAP revenue was $59 million. So this is excluding the SynLogic round trip. But then they add back the SynLogic round trip to create a new metric, uh, billable revenue. This is what we talked about earlier. Now, he is using this as evidence. The fact that they do not include the round trip as their in their gap revenue, he's saying, "Oh, this shows that they're not being shady at all, right? They're not because they're not even recognizing it as revenue." But he makes no mention of the fact that they give this extremely misleading projections where they say that the billable revenue and the gap revenue will be the same going forward, which is impossible. So how is this ARK Invest person? This ARK Invest person is trying to justify that everything is above board, and he specifically points to something from their SPAC presentation where they're giving obviously absurd revenue projections because they are not projecting the gap adjustments, which are guaranteed to happen because they have a 5-year deal with SynLogic that will result in these gap adjustments all the way through 2024. And one last thing to talk about is the massive amounts of insider selling at Ginkgo Bioworks among their management team. So, in the past 12 months, uh, insiders at Ginkgo have bought 1 million shares of the stock. But in the same period, they sold 75 million shares of the stock. So there's a massive amount of net selling, a net selling of 73 million shares of Ginkgo stock. So obviously the management team, they don't have confidence in the company. They're monetizing, selling hundreds of millions of dollars worth of stock. Well, depending on what was the price, probably only tens of millions, given that the stock has declined so much. But you have a situation where you get misleading press releases, downstream revenue which is not materializing, massive losses, and misleading numbers in the SPAC presentation, and management is dumping their shares hand over fist. This is a huge number of red flags, and when you take all of these together, this gives me huge concerns about the company. And just because the price is again, just because the price has declined by 80%, if it goes to zero, that's going to be down another 100%. And given that the business has failed, they're receiving immaterial downstream revenue. I think, in my personal opinion, I think this is a stock that will eventually go towards zero.
So, James, um, given all this reality about this company, what is the end game for this company? Like, why are the CEO and founders and whoever like continue operating this company that's obviously like not a viable business? And like, what's in it for them? And what's the company going to look like 5 years from now if it still exists by then?
Well, they're losing. One thing is they have a lot of cash. I think I'll go. Yeah, see, so they still have $1.1 billion of cash. So because they raised so much money from the SPAC, uh, but with that being said, they're also losing huge amounts of money. In the past 12 months, they lost $1.3 billion. Now, a lot of these losses are stock-based compensation, so the actual cash outflow was not nearly as much. But um, but that's still an expense. So this company is losing, despite the fact they have a lot of cash, they're losing a huge amount of money. And as we talked about extensively, the business is not working out, and I see no reason to believe that anything is going to change fundamentally. So, and that's why the insiders are selling probably is because they see that there's not really a bright future. If your stock is down 80%, yeah, you're still selling the stock as the management team. That is not a good sign at all. So I think it's going to continue to lose money. The free flow is going to continue to increase as they do massive amounts of stock-based compensation, and the insiders continue to sell. And I think probably the path of least resistance for the stock is to continue going downwards.
I think for me, like the biggest thing that I would take away from this company is that like the we've seen this also with other like small SPAC type companies that don't really have a viable business, but try to kind of almost like make a business out of hyping up their stock to retail investors, right? So James, when you and I were before we started the podcast, we were looking at this video, this kind of hype video that Ginkgo put out to hype up their stock, and I think what it really shows is that although there is real science in the industry that they're in, like it's really what Ginkgo is really dealing with is pop science, right? Like I think people of a certain generation, like our generation, growing up, you heard about scientists with promises of being able to like revive the woolly mammoth or something like that. And you can see that that's clearly what this video is trying to appeal to with the, as you can see, the dinosaur in the background. Even though it really has nothing to do with the core business of Ginkgo itself, it's clearly meant to appeal to the emotions of investors. And you can kind of see that as well with Kathy Wood being all in on the stock, which also goes to show kind of Kathy Wood's lack of judgment and not being able to kind of see past the facade that Ginkgo has kind of tried to create around the reality of their business.
Yeah, I mean it's quite cringy to look at some of the stuff Ginkgo puts out there. They have all the dinosaurs and stuff. The actual business they're in has nothing to do with dinosaurs. And there are many other companies. Um, for example, Merck was actually one of the first companies to do synthetic biology all the way back in the 80s. They created vaccines using synthetic biology, but you never see Merck putting out videos or pictures of dinosaurs and stuff like that. But Ginkgo, which is way less successful in actually doing synthetic biology, we can see that by their immaterial amounts of downstream revenue. So, uh, but they're still doing all these having all these dinosaurs and all this. So you can really see that, at least in my opinion, this company is really it's more hype than real science.
Yeah, like they're a B2B business, right? So they
Yeah.
should be focusing on the actual science, not on making cool dinosaur videos that like oh like I want to see a triceratops in real life, and so I'm gonna be excited about what this company is doing.
Yeah. Well, unless you have anything else, Ryan, I think that about wraps it up with everything we had to talk about Ginkgo Bioworks today. As always, if anybody in the audience has any thoughts on the company or anything you think we missed, please let us know in the comments section below. And with that being said, we'll sign out for today and see you on the next one.